Good morning. This is Team C, and we are here to do a presentation. Our topic is Chapter 27, Tools of Finance. So, for this presentation, we will divide it into three parts. The first part is chapter summary. Second part is the question 4. The third part is question 8.
What is finance? Finance typically focuses on the study of prices, interest rates, money flows, and the finance markets. Finance tends to center around topics that include the time value of money, rates of returns, cost of capital, optimal finance structure, and the qualification of risk. After we learn the basic tools of finance, we know that finance is the field that studies how people make decisions, regulating the allocation of resources over time, and handling risk. After we learn the basic tools of finance, we can make use of it and make profit in the future.
So, what is present value? Present value is refers to the amount of money today that will be needed to produce using prevailing interest rates and a given future amount of money. It could receive a given sum of money in the present, and that is preferred to receive the same sum in same amount in the future. By using present value, we can compare it with the current market value, which determine if we should buy the stocks or goods.
Next, I would like to talk about how to calculate the present value. The present value formula is future value over 1 plus r power to the n. R is interest rate and n is number of years. If R is interest rate, amount x receive n years. That means earning interest has the opportunity to reduce the present value below the x value.
So, let's talk about future value. So, what is future value? Future value refers to the amount of money in the future that's an amount of money today will yield. Given the prevailing interest rates, is called the future value. And when we are given the future value, usually during a question, we will be calculating the present value using the future value. And remember that future value will not use to compare the price. We only compare the price with present value. Now let's move on and talk about risk. So what is risk? Every time when you invest something, there is a risk involved. But sometimes the risk may be too high and you are so afraid and you don't know what to do. So there are a couple ways that you can reduce the risk. The first thing is to buy insurance, such as medical insurance. So for example, if you buy medical insurance, then the insurance company will pay your medical bills whenever you have a sick. Then you don't need to pay yourself because the insurance has covered it. Second of all, you can diversify your risk. So for example, instead of buying stocks in one single company, you can buy stocks in different company. And the third thing is to accept lower return on their investments. So if you accept low return, that means you have low risk. So there are two problems in insurance markets. The first problem is adverse selection. It means you buy before the accident occur. You're trying to play safe. So for example, you are an old person and you predict yourself in the future that you will be getting a cancer. So if you are that person, then you will buy insurance immediately. So whenever you actually have a cancer, then you can use your insurance to cover all those expensive medical costs. The second problem is the moral hazard. For this problem, the people have already buy insurance before the accident occur. And the people in their mind, they know that because they have buy the insurance, so that whenever they do or whenever the sickness they have, they don't need to worry about it because they already buy insurance, and insurance will cover everything, and therefore they are more likely to cause accidents. So for example, if you buy medical insurance and people already know they have an insurance cover on medical expenses, so therefore they are less likely to risk to avoid getting sick. Okay, but the prices of the insurance may change according to different people. Okay, for example, for car insurance, the seller will ask your car condition, whether your car is brand new or whether your car is already driven for 10 years, 20 years. Why they want to know this? This is because if your car is very old and is weary and is likely to broken, then the insurance will be charged very high because your car is very likely need a maintenance in the past few months. But if your car is brand new and it's never been driven before, then your insurance fee will be very low because it is less likely or almost impossible for your car to break down, right? Let's talk about diversification of idiosyncratic risk. This means we separate a big risk with many little risks. So for example, you buy small amounts of stocks from different firms instead of buying large amount of stocks in one single firm. Why we do that? Because we want to separate the risk. If unfortunately you buy many stocks in one single firm, and if that single firm has due to bankruptcy, and then all your stocks will have zero value. But instead, if you invest in different company with just little amount of stocks, then if there is one company suffer from bankruptcy, then you only will suffer a small amount of loss. Now, however, idiosyncratics cannot avoid aggregate risk. Aggregate risk is a risk that is unavoidable. So it's also called unavoidable risk, such as coronavirus or natural hazards, because this kind of risk is not able to prevent using any different methods. And these kind of risk, you are not able to avoid it by purchasing insurance. So what are the determinants of buying stocks? Well, from the previous slides, we know. Actually, the determinants of buying stocks is to evaluate asset. What do you mean by evaluate asset? It means we will have to compare the share price and the present value. So, by calculating the present value, we can compare it with the share price. And then when the share price is larger than the present value, this is overvalued, which means it is not worthy to buy right now. But if the share price is smaller than the present value, this is called undervalued, which means the current value is actually worth more. So actually the stock is actually worth a lot more than what it actually costs. So in this case, we will buy the stocks.
Question 4. Imagine that you intend to buy a portfolio of 10 shares with some of your savings. Should the shares be of companies in the same industry? Should the shares be of companies located in the same country? Explain. So let me talk about what is a portfolio first. A portfolio is focused on assets such as stocks, shares, foreign currencies, and real estate. And a great quality of portfolio should have the elements like it is stable, it has a high liquidity, and it has a low investment risk. Also, a portfolio is not able to include depreciation such as television or some machines. It is because the value of a portfolio must be potential to increase in the future. But the most important element is diversification. It could make a portfolio become good. The reason is that we don't want too much risk from the portfolio. So we need to spread our investments. In case some of the portfolio items are failed, we will not get that huge loss because we spread out all our investments, and that's why we need to create a portfolio to protect our investment. Also, portfolio is not only about what you buy, what the items you have, but also about the people, which are known as activist investors and robust investors. The goal of an activist investor is to maximize the value of their portfolio in the shortest possible time, but the robust investors have emphasized the stability and regularity of their current income, so they usually choose bonds with higher credit ratings, high dividend, and safe stocks.
Before we get into the question, we need to note investment portfolio comes with political and economic risk. Our purpose is to maximize long-term investment returns. The shares should be comes from different places. We need to make sure that some asset classes can be beneficial. A diversified portfolio is the best defense against the financial crisis. The most important thing is that we need to make sure our assets do not correlate with each other. Move on to the question. Should the shares be of companies in the same industry or be of companies located in the same country? The answer is no, because there is no diversified. It means that we need to take a huge risk because you had chosen the correlate assets. We need to consider some issues such as government policy and interest rate, because those elements can create stock price fluctuation. If the stock price fluctuation is downtrend fluctuation, our assets will become negative immediately. So doing diversified is to protect ourselves. We need to avoid the singularity of the portfolio. We need to decrease our risk. A portfolio should mix with domestic stocks and bonds. Other choices can be real estate or a commodity. We do not put all the investment in the same basket.
So now, let's go through question 8. When company executives buy and sell shares based on private information they obtain as part of their jobs, they are engaged in insider trading. So now let's go through question 8a. Given an example of inside information that might be useful for buying or selling shares. Before I demonstrate with an example, I would like to explain a bit more about insider trading first. This behavior is genuinely illegal. In most of the cases I reviewed in the past, the victim will try to obtain non-public material information in an illegal way, such as corruption or hack into the company's computer system in order to get latest undisclosed information. They will make use of this information to persuade others to buy shares so that the victim will gain profit from it. However, in this case, company executives can receive private information due to their title of work, so technically it's not illegal. One of the examples is that they heard a piece of inside information saying that their company A is going to be acquired by another company B. Assume they have bought both companies' shares beforehand. When they heard the news, they will buy more shares of Company A and selling the shares of Company B. This is because, during acquisition, Company B will have to pay acquisition premium to Company A, which will increase Company A's stock price. On the other hand, since Company B have to pay large sums of premium to Company A, therefore they are likely to suffer in cash shortage. Therefore, stock price of B will decrease. In conclusion, company executives can buy more stocks of A and sell stocks of B in order to gain more profit with the help of the inside information.
So now this is Elena. When company actively buy and sell shares based on price information, then officers as part of their jobs. They are engaged in inside trading, horizontal to the trade service based on inputs from information, usually yield very high rate of return. Does this factor the fallacy defeat the market hypothesis? So we can look at the answer. This fact validates the efficient market hypothesis. Examples: 1. The staffs of the stock companies always order to buy and sell securities based on inside information. 2. A senior acquisition of the companies divulging inside information to others so that they can use it in the information from inside trading. 3. A person who is not an inside buyer of sells security on the basic information obtained by him or her are of this to do so. These are examples of when several reasons which transparency and fair competition are affected. So it validates the efficient market hypothesis.
Let's move on to talk about the next problem and application. Inside trading is illegal. Why do you suppose that is? First, I would like to talk about what is insider trading. The original intention of the transaction is to ensure that each investor trades in a fair and just environment. Insider trading refers to acts by the insider and another person who obtain insider information by improper means in violation of laws and regulation. Look inside information, buy or sell securities based on insider information, or make recommendation to others on buying and selling. For example, in 2009, Hong Kong Dujun case refers to Dujun, a former managing director of the fixed income department of the investment bank Demo Asia in Beijing, because he was found guilty of insider trading while serving as a financial advisor in Hong Kong. 7 years in prison. A Hong Kong judge convicted Dujun of 10 counts of insider trading and sentenced him to 7 years and 3 months in prison. Next, I would like to talk about why insider trading is illegal. In order to achieve profit or hedging purpose, insider trading actors use their special status or opportunities to obtain insider information of the securities market and violates the right to equality of information and property of the investing public. For example, the Dow Jones insider trading case in 2007 was an insider trading incident in which Hong Kong celebrity Lee Guobao was involved as a director of US-listed company Dow Jones. In 2007, as an listed director of Dow Jones, Li Guobao learned from his position advantage that there would be an important acquisition transaction. He intentionally or unintentionally notified his friend Li Jin'an so on, which caused the latter to buy Dow Jones stocks unusually. As the stock price soared, Liang Jin'an and others made huge profits. Later, Li Guobao and others were sued by U.S. Security and Exchange Commission. Li Guobao willingly paid a fine of settlement out of court, but did not admit to the outside world or deny that he was guilty.